Volatility is vitality. If you're going to hold the asset, you need a 4-year time horizon as minimum. A 10-year time horizon is really the right time frame. Volatility is Satoshi's gift to the faithful. He basically gave you the ability to rise to the top of your profession. If you need exactly down to the penny, $87.17 in 2 weeks, you probably want to put your money in a bank or a money market. If you have a 4-year time horizon or longer, if you have money you don't need for 4 years, then you buy Bitcoin. I think it's a bit alarmist. I also think it's already priced into the market by a factor of 10. At the end of the day, if you look at the chart of Bitcoin for the past 15 years, there's 15 major drawdowns. It always comes back to an all-time high. There's a billion people. They want to hold the money in their hand. They want to move the money at the speed of light. They don't want to be dependent on 20th century financial structures. They don't trust gatekeepers. Giving guidance to banks that it's okay to custody crypto assets, it's okay to actually handle them as part of staking and fee allocations, and it's okay to extend credit. And that is the most profound thing that's happened in 17 years in this industry. And if we keep our eyes on that, then the near-term volatility is just going to be noise.
Michael Saylor opens by addressing the core reality that many Bitcoin investors forget. Volatility isn't a flaw, it's the engine that powers long-term performance. With markets pulling back and MicroStrategy stock under pressure, investors across crypto and traditional equities are once again questioning their time horizons, risk tolerance, and conviction. Saylor reminds listeners that Bitcoin is designed to be volatile, and that anyone entering the asset needs at least a 4-year outlook, ideally 10. Short-term traders may view market swings as pain, but he argues that volatility is what creates opportunity. Without it, Bitcoin would be owned entirely by traditional asset managers and institutions, leaving no upside for the early adopters. Before we continue, make sure to like the video, subscribe to the channel, and turn on notifications so you never miss new breakdowns, interviews, and market insights. Feel free to share your thoughts in the comments below. Your engagement helps the algorithm and supports the growth of the channel. Enjoy the video.
You know, as I say, volatility is vitality. Bitcoin is a volatile asset. If you're going to hold the asset, you need a 4-year time horizon as minimum. A 10-year time horizon is really the right time frame. If your time horizon is less than 4 years, you should hold the credit instruments like digital credit. And if you're an equity investor in a digital equity like my company, you need that same 4 to 10-year time horizon. 4 is the short term, 10 years is the long term. I'm an officer of a publicly traded company, and what are we doing? We are in the business of buying a high energy, highly volatile asset and stripping the risk and the volatility off of it in order to sell it to people that are much more risk adverse, that are much more volatility adverse, that just want that yield. And so if Bitcoin wasn't volatile, it probably wouldn't be high performance, and then our value added wouldn't be that great, right? Like, for example, I say to people, if you knew Bitcoin was going to go up 2% a month forever with no volatility, neither you nor I would be in business, because all the conventional finance investors, all the conventional journalists, they would dominate the market. Warren Buffett would own all of it, and there wouldn't be an opportunity for us. So I look at the volatility as it's a challenge, but it's also the bug is the feature. And I say to people, you know, volatility is Satoshi's gift to the faithful. He basically gave you the ability to rise to the top of your profession as an analyst, as a journalist, as a corporate operator, as an investor. And if the volatility goes away, no one cares about your opinion on any of this. It's like, you know, you've got fire, and we've got the phrase burned. Fire burns you and electricity shocks you. And Henry Ford created an automobile, you know, with a burning engine, with a fire in the engine. And we created electronic transmissions. And so you put electricity and fire in the car, and you've got a killer consumer product. And I think the key here is you got to look at this market and say, this is indicative of energy. You can harness the energy you can't be scared of the energy, right? There are those people that run from the fires, and then there's people that put the fire in the automobile or the jet airplane. And we kind of need the people to build the airplanes and build the automobiles if we're going to move the civilization forward. So the volatility comes with the territory.
Of course, I know you've responded on X, but MicroStrategy shares are down almost 70%. That's a pretty big fire. I mean, what's your message to shareholders? Is it just hold on and things will get better?
My message is, if you have a 4-year time horizon or longer, if you have money you don't need for 4 years, and you don't want to take any counterparty risk to a currency, a country, a company, a culture, a competitor, then you buy Bitcoin. And if you're an equity investor, and if you want amplified exposure, if you want to invest in the future of digital capital and the future of digital credit, and you're enthusiastic about, like, we think we can sell a treasury credit product that's really compelling and very interesting to 1 billion people, right? 1 billion people would love to have a bank account that pays 10%. If you would like to invest in that future as an equity investor and you don't need the money for 4 years or longer, then you can hold the equity. If you need the capital in the next 4 years, then you probably want to be a more risk-averse investor. You need to look at a credit instrument. And if you need exactly down to the penny, $87.17 in 2 weeks, you probably want to put your money in a bank or a money market, because that's just what you need. And so I think every investor has to decide what's their risk tolerance, what's their time frame, and are you a credit investor, are you a capital investor, or are you an equity investor? And then once you've made that decision, you can decide how to allocate your portfolio.
And lastly, I just want to ask you about the JP Morgan report that came out this morning, warning that strategy could be excluded from benchmarks like NASDAQ, MSCI, and it could trigger an estimated $2.8 billion in automatic outflows. That's just from the MSCI alone. What's your response to that?
I think it's a bit alarmist. I'm not so sure the numbers are nearly that high. I think actually the numbers would be much smaller. I also think it's already priced into the market by a factor of 10 if you count it. I don't think there's any relationship between the decision making of MSCI and the NASDAQ 100 or the S&P 500 index allocators. The company is an operating company. It's just like insurance companies use capital in order to create financial products, and banks use capital to create financial products. We use capital to create digital credit finance products. It's possible there are people in the world that don't fully appreciate digital credit or digital treasuries. That wouldn't surprise me. We had that challenge with bankers that didn't want to bank Bitcoin. We had that challenge with accountants that were a little bit skeptical of digital assets accounting. The accountants embraced the asset, the bankers embraced the asset, the politicians embraced the asset. We had the challenge with credit rating agencies, and they just embraced the asset. We're starting to get credit ratings. We have the challenge under the Basel Accords, where Basel Accords allocate zero value to Bitcoin, and now they've announced they're going to reconsider that. So I'm not concerned that we have these kind of concerns. I think we'll educate all of the companies in the space. Ultimately, it's above my pay grade to decide whether MSCI embraces digital asset holders or digital credit or not. It's just like it's above my pay grade whether the S&P 500 puts us in the index. But what I would say is, over the long run, it doesn't matter, because over the long run, this will create near-term volatility. But if the world wants a bank account that pays them 10% rock dividends, and if Bitcoin is digital capital superior to gold, then it's not going to matter what an equity index allocator decides. If the insurance companies don't want to buy Bitcoin and the banks don't want to buy Bitcoin, or the index allocator doesn't want to support a digital treasury company, the free market is going to allocate capital and it will adjust. It just creates a bigger opportunity for some other equity investor that will pile into this particular asset class and support these kind of companies. So it is what it is. It'll work itself out. I think Whenever there's a lot of volatility in the market, and right now, clearly we've had a lot of volatility of late, we're living through about a 35% drawdown. I remember what it was like when we had the crypto winter and there was a 75% drawdown. When you have a massive drawdown, everyone looks for a reason why, and they will grasp it. Is this the reason why? Everybody wants a reason to explain their pain or the storm or the volatility. Is it the crypto exchange, liquidation bots, or is it this, or is it that? At the end of the day, if you look at the chart of Bitcoin for the past 15 years, there's 15 major drawdowns. It always comes back to an all-time high. There's 5 brutal pullbacks in the past 5 years. This is not the most brutal. All of those things have happened without the support of the politicians, without the support of the banking industry, without the ETFs, without the IBIT derivatives market, without the support of MSCI, without the support of the S&P index. I could go on and on and on. The reason that digital assets are spreading around the world is because there's a billion people. They want to hold the money in their hand. They want to move the money at the speed of light. They don't want to be dependent on 20th century financial structures. They don't trust gatekeepers. And they would like to move forward with their lives with some control, with financial freedom and sovereignty and property rights. And those fundamentals are stronger than ever. We just had the Secretary of the Treasury, Scott Bessent, show up at the launch of PubKey in Washington, D.C. last night, right? And so in the midst of all the crypto chaos and people worrying about, well, will these guys say that and will this happen? You have the most powerful financial regulator in the world implicitly showing his support for the crypto economy, for digital gold, for Bitcoin, and explicitly giving guidance to banks that it's okay to custody crypto assets. It's okay to actually handle them as part of staking and fee allocations, and it's okay to extend credit. And that is the most profound thing that's happened in 17 years in this industry. And if we keep our eyes on that, then the near-term volatility is just going to be noise. We have to work our way through it cheerfully, constructively. It'll eventually pass. People will look back and smile and say, you remember the day when that news story came out.
Saylor emphasizes that Bitcoin's volatility is what enables strong long-term returns. Every major drawdown in the past has eventually led to new highs, and the key factor is simply having a multi-year time horizon. He argues that Bitcoin's price swings aren't caused by single headlines or index changes, but by a larger shift as digital capital replaces traditional financial systems. Short-term turbulence is just the market adjusting to this transition. Despite recent pullbacks, Saylor remains bullish, pointing to regulatory progress, institutional adoption, and growing global demand as signs that the broader cycle is still intact. If you're enjoying the analysis, don't forget to like, subscribe, and enable notifications.